All right, so if you're an entrepreneur or maybe an investor and you've got your eyes on the UAE, you've probably heard this term thrown around, withholding tax. Now, most countries have it, but you'll find the UAE's approach is, well, it's pretty different. It all comes down to a simple question. But believe me, the answer can have a massive impact on your bottom line. So let's just dive right in and tackle that question. Honestly, understanding this is absolutely key for anyone who's making or receiving payments across UAE borders. And here it is, the core of the issue. When a company inside the UAE pays a foreign business, for something like dividends or royalties, does any tax actually get withheld from that payment? Okay, before we get to the big UAE reveal, we need to make sure we're all on the same page about what withholding tax even is. If you can really grasp this basic concept, everything else is going to click right into place. The key thing to understand here is who pays the tax. Withholding tax kind of flips the normal responsibility. It's not on the person who's receiving the money, but on the one paying it. They have to deduct the tax upfront and send it straight to the government. So, you see, the government gets its cut before the money even gets to the final recipient. Let's just walk through a super quick example so it makes sense. Imagine a company owes you some royalties. They start the payment process, but hold on. Before it ever hits your bank account, they deduct the tax that's required. That tax money goes directly to their government, and then you receive what's left over. It's a pretty simple four-step deal.
Okay, so we've got the basics down. Now it's time for the big reveal. Let's talk about the UAE specifically. How does all of this apply to payments that are coming out of the country?
This is it. This is the million-dollar question for any foreign investor or any business working with the UAE. When a company there pays you, how much of that payment is going to be withheld for tax? That's right, zero. A big, round 0%. This is easily one of the most powerful and attractive features of the UAE's entire new corporate tax system. For most payments that are going out of the country to non-residents, absolutely nothing is withheld. And just so you know, this isn't some informal policy or temporary thing. It's literally written into the law. As part of the new corporate tax law that kicked in on June 1st, 2023, the rate was officially set at 0. I mean, this is a total game changer. So, what does this 0% rate actually mean for your business? Well, to put it simply, you keep more of your own money. It makes pulling profits out of the country way easier, which directly boosts your net income. Plus, it cuts out the administrative nightmare of trying to deal with complicated tax treaty claims. It just makes the whole process of doing business with the UAE remarkably straightforward. But hold on a minute. It's not always that simple. While the UAE won't tax payments that are going out, what about payments coming in to your UAE-based business from other countries? That's where the bigger picture gets a little more interesting. This brings us to another really key concept: Double Taxation Treaties, or DTTs. The best way to think of them is like a rule book agreed upon between two countries that decides who gets to tax what and when. Their whole purpose is to make sure your income doesn't get taxed twice and, to encourage global trade. And here's why these DTTs matter so much for a business in the UAE. Let's say you're receiving dividends or royalties from a company in Europe. Well, that country's government is probably going to want to apply its own withholding tax. A DTT can dramatically lower that tax rate, sometimes even to 0, and that can save you a whole lot of money. And right here, you can see that exact theory in practice. Just notice the differences. Royalties coming from the UK or Germany, boom, they have a 0% withholding rate because of their treaties. But for the very same type of payment from India or China, you're getting hit with a 10% rate. This is precisely why these individual agreements are so critical to your bottom line. So the landscape is pretty clear. It's 0% on payments out of the UAE, but you've got this complex web of treaties for any payments coming in. How can your business stay prepared and make sure you're compliant? The most important thing is not to get complacent. Because the corporate tax law is still pretty new, you've got to stay updated with all the guidance from the Federal Tax Authority. You need to keep meticulous records of every single cross-border transaction. And this is critical. Make sure you have your tax residency certificate ready to go. That's basically the golden ticket for claiming benefits under these treaties. And that brings us to our final takeaway. The UAE's 0% withholding tax rate is, without a doubt, a massive advantage today. It makes it an incredibly attractive place to do business. But the international tax world is always changing, always